Evening. Good evening.
Good evening, Malim.
Hope today will not have the challenges of internet. Am I clear enough?
Yeah, you are.
Okay, let's give the rest like 2 minutes or three, then we'll start.
Okay.
I think we should start. I can see a good number has joined the class. We need to start so that we can also clear a bit early. Hope everyone is able to get me. I've indicated that make sure you indicate your student number against your name for me to be able to mark my class register. There's someone who has joined as Neon Ray. I don't know who is that. There's no admission number. There's Johnson Omonyi. Kindly indicate your admission number. Make sure when you are joining, you indicate your admission number, because that is what I'll use to mark class register. I want us to start off our today's class. Hope you have submitted your assignments and your card and your quiz. We'll do some work today, then we'll be able to give the second quiz, which will be due the next class. So I want us to start today. We had introduced the management of exchange rate exposure, which we are calling the hedging. We talked of internal methods. Someone to remind us of the internal methods which a company can use to manage exchange rate exposure. Someone to remind us of the internal methods a company can use to manage exchange rate exposure.
One is okay. Hello, madam.
Yes,
One is leads and lags.
there's leads and lags.
You can pay early
You
or delay payment.
can pay early or delay payments. Number two,
Then there's matching.
there's matching.
Yeah, payables and receivables.
You match payables and the receivables to mature at the same date. Someone else will give us the third one. Someone else to give us the third one. We talked of 5 internal methods. There's leads and lags, there's matching. Another one. Another internal method that a company can use to protect itself or to hedge against exchange rate exposure. Yes,
Hello. I think there is netting and invoicing.
there's netting,
Hello, netting.
then there's invoicing. And the fifth one, we talked of 3, 5.
I think something like operate foreign currency.
Operating a foreign currency account. So those are 5 internal methods which a company can use to hedge itself against foreign exchange exposure. Today we are going to introduce the external methods. We said there are internal methods and the external methods. Today we are going to introduce the external methods. With the external methods, we said it's use of derivatives to hedge against exchange rate exposure. I know those who are doing financial risk management are discussing what we call derivatives. But derivatives, we said they are mostly used for by speculators in the market, in the exchange market, whereby they hold derivative hoping to make profit from the fluctuations of the exchange rate. We had listed several derivatives which can be used to hedge against exchange rate exposure. The first one was what we called forward contract. Forward contract. The second one is what we called future contracts. Future contracts. There's what we call market options or currency options. Then there's what we call currency swaps. Then the last one, money market hedging. Those are some of the derivatives which a company can use, which we are going to discuss into details, how the company can use these derivatives for purposes of hedging against exchange rate exposure. Remember in our last class, we agreed that exchange rate exposure can exist in 3 forms, which is economic exposure, translation exposure, and transaction exposure. We said of the 3, it's only one which is a real cash outflow or a real cash gain or loss. That is transaction exposure. And we talked of transaction exposure is whereby you have a transaction, either receivable. I decided to capture that because I know there are some people are joining the class for the first time, or a payable, which is denominated in a foreign currency or a different currency. So if you have an outstanding debt to be paid to you, or you owe someone money and that person gave you an invoice, or you gave the person an invoice in foreign currency, then that transaction is exposed. It's facing what we call a transaction exposure. There's a likelihood when the person will be paying you, the rate can change to your favor or against you. Or when you will be paying the person, because you have to buy the foreign currency, the rate can also go against you or in your favor. So that is what we call transaction exposure. And in our course, we are going to concentrate mostly on how to manage transaction exposure using the external methods, which we have listed as the derivatives. We have done a list of the derivatives, which you can use to hedge against the exposure. So we are going to start with the forward contracts. And I know you had defined what is a forward exchange rate. What's a forward contract? Forward exchange rate? So we are going to start with forward contracts. What do we mean by forward contracts? I know you must have discussed with the Daktari about forward rate or forward exchange rate. These are rate agreed today to be exercised in the future. To be exercised in the future. So when you talk of forward contracts, it's whereby you go to the bank, you know that you should be paid some amount. Let's look at it from the receivables perspective. Let's assume you have sold to a company which is US and you have issued an invoice of 100,000 US dollars. And this company is supposed to pay you after 3 months. Let's assume the spot rate, which we say we defined as the rate as at now in the market, is one US dollar equals to 100 Kenya shillings. Now you go to the bank, you tell them at such a date, 3 months from now should be around May. Maybe May, I love 100,000. At what rate will you buy this currency from me? At what rate will you buy this currency from me? So whatever they do some speculation computations and they give you what we call forward rate. They give you what we call forward rate. So you get into contract with the bank. They agree that if you come with the money, maybe we are going to do at 101, 102 Kenya shillings. So you know that when you will be paid your money, remember these are receivable, you will go to the bank. You have already agreed on the forward rate. So regardless of the prevailing spot rate on that date of payment, you already know your cash flow, you already know what you will get because you have entered into a contract or an agreement with the bank that was, so in May, at the end of the May, once I'm paid my receivable, you will buy it from me at this rate. Now I want to ask a question. Now, let's assume the May comes and you are paid this amount. At what rate will you exchange it? At what rate will you exchange it? This is a spot rate when you are getting into the transaction, but you get a forward rate from your bank. You agree a rate today to be exercised after 3 months when you are paid your amount. So now let's assume you have agreed. This is the rate. They give you this a forward rate. Then come May, you are paid your money. At what rate will you exchange that amount? At what rate will you exchange that amount?
At 101.
At 101. Reason being, you have the money, it's a foreign currency, you are going to the bank. I like emphasizing on the buying, selling price. You are going to the bank to sell this currency, the bank is buying from you. So they will do at 101. So that is what we call forward contracts. I want to get another example. Let's assume that you have done sales, you are supposed to pay, you have bought some raw materials. So you have a payable outstanding, which is 100,000 pounds. The prevailing rate, that is a spot rate, is at now in the market. You realize it's 1 pound equals to 120, 121 Kenya shillings. Then you go to your bank, get to agreement with them that my forward rate, I'm receiving this payment after 3 months, then they give you a forward rate of 119, then 120. Then this is a spot rate. Let's assume the transaction happens today, which is 17th of February, 2021. So this is a spot rate is at 17th of February, 2021. This is a forward rate for 3 months, 3 months forward rate. This is 3 months forward rate. Then now, at the end of the 3 months, let's assume the 3 months are ending on 31st of May, 2021. You realize the spot rate on that day is £1 equals to 121, 122 on the day of the transaction, the maturity of the transaction. My first question would be, if you hedge using forward rate, what will be how much will you spend to make the payment? If you use the forward rate, how much will it cost you in Kenya shillings? How much will it cost in Kenya shillings? Then number 2 question, if this is a spot rate if you speculate or do some computations and realize this will be the spot rate on that 31st of May, would you prefer to go for forward contract? Would you prefer forward contract or stay unhedged? Those are the 2 questions I have for this example. Would you prefer to go for forward contract or you would prefer to stay unhedged? Someone to give it an attempt? These are payable. The first example was a scenario of a receivable. These are payable. You are supposed to make payment to someone, but it's denominated in foreign currency. So you are facing what we are calling a transaction exposure. So now you go to the bank, you have discussed your forward rate to be this one. But maybe the accountant back in your office convinces you that the spot rate will be this on the maturity of the transaction. The first question is, if you opt to go for forward rate, how much will it cost in Kenya shillings to make the payment? Then the other question is, if you decide to go if you suspect that the rates will be these ones in future, you need a forward contract or you would prefer to stay unhedged? You don't take the forward contract. Someone to give it an attempt? I think let me just do the computations for us to move a bit faster. So in this case, if you decide to go for forward rate, at what rate will you buy the pounds? You have decided you get forward contracts. You have discussed the rate, it's this one. You will be buying pounds because you're in Kenya and you need to make a payment in pounds. So at what rate will you buy the pounds? What rate will you buy the pounds?
120.
120. So you'll buy at 120 times 100,000. So if you decide to go for that, then you will spend 120. That is the amount you will spend in Kenya shillings. That is 12 million to pay your payable. That is the amount you'll spend to make the payment or to pay for your payable. Now, let's assume you stay unhedged. You decide that these rates will be prevailing on the date of maturity of this transaction. Remember, you are going to buy the currency at 122. So if you stay unhedged, you'll do the exchange at 122 times 100,000, which will give you 12,200. So if you decide to stay unhedged, you are likely to spend more. Hope you can see that. You are likely to spend more on that transaction. So it is better you take forward contract to protect yourself from this exposure. The rate can also go to your favor. It can go opposite. So it can go either way, but you need to know what rate at which you are buying the currency. Then you make a decision. If the speculation shows that this rate will be 122 and they're giving you a forward contract of 120, then you better get the forward contract. Forward contract has some shortcomings. It has some disadvantages. The first one faces what we call the counterparty risk. Remember, this is just an agreement between you and the bank. On the maturity of the transaction, you can decide not to honor the performance. These are contracts based on performance. On maturity of the contract, you may the supplier might not the customer might not pay you on time, so it means you not deliver on your side. Or you might go to the bank and you realize that the exchange rates are so bad that they refuse to honor their part. So it faces what we call a counterparty risk. The other thing, it does not allow you to take advantage of the rates. Does not allow you to take advantage of the exchange rates if they go in your favor. So it does not allow you to take advantage of exchange rates if they go in your favor. The last one, it is not standardized. It's not regulated. There's nowhere you can say that it is not standardized. It's not regulated. There's no regulation on that. So that one poses the one which makes the counterparty risk to be a bit high. It also has its own advantages. It has its own advantages. The first is customized. It is customized. So unlike the other modes of the other methods of hedging we'll be discussing, which are not, because they are standardized, they have standard sizes. So if you want to hedge, you cannot get a customized one. So it can be customized to fit to your requirements. The second one, it helps to hedge. You can look for more advantages and more disadvantages. I know there are many in the book, so I don't want to dwell on the theory. The next hedging tool I want us to discuss. Kindly, whoever is on is unmuted, mute to control the background noise. Someone mute kindly to control the background noise. So the next method I want us to discuss today is what we call money market hedging. Money market hedging. This is more or less like matching. This is more or less like matching. This is whereby, let's assume you have a receivable you are expecting to receive. Just a minute, kindly. There's someone who wants my assistant somewhere. Just a minute. So the next method I want us to discuss is money market hedging. I've mentioned that it's more or less like matching. This is whereby, let's assume you have receivable denominated in US dollars. You create a payable. You have a receivable which maybe it's maturing on 31st of June. I don't know whether it's 31st of June, 2021. What you do, you create a payable in US dollars maturing on the same date. You do this by borrowing. Let's assume you are expecting to be paid $1,000. You go to the bank, borrow a loan, which at the end of at this date, 30th of June, 2021, the principal loan plus the interest will be equal to $1,000. So you borrow a loan such that on maturity it will equal to the receivable that you have. So what you do after borrowing the amount, you can convert into home currency. You can convert to your home currency. You can convert to home currency using the spot rate. Remember, pesa yako utapewa saa hizi. So you can convert to home currency using the spot rate and invest. Maybe you can put in fixed deposit. fixed deposit to earn you interest, or you can invest in another business which has more returns. So what the process is, once you have a receivable maturing on 30th of June, you go to the bank and create a payable maturing on the same time, which is equal to the receivable. So when you are paid the receivable of 1,000, you just go to the bank and pay their loan of 1,000. So you don't need to convert it to the local currency because you already have a loan with the bank, which is in US dollars, and you are going to pay it off once you are paid. If it's payable, how do you go about it? That first case was a pay receivable. In case of payable, you are supposed to pay. You are supposed to pay in the next, let's assume by 31st of June, 2021. You need to pay raw materials worth 1,000 US dollars. So you create a receivable. Which is maturing on that 1st of June 2021, which you will liquidate then and pay. So how do you go about this? How do you create a receivable? What you do, you go to the bank, borrow amount which will be equal to 1,000 on maturity of a deposit. You borrow the loan, convert it to you borrow in local currency. In this case, you are borrowing from your local currency. Convert to the US dollars. You convert to US dollars at the spot rate. Convert to US dollars at spot rate. Then you put that amount in dollars. You put in a fixed deposit. And it should be an amount which will be equal to this. Once the fixed deposit matures on 31st of June 2021, should be equal to 1,000 US dollars. So what do? You liquidate your fixed deposit and pay your loan. So the money market hedging says that you can only be sure of the current rate. So you take advantage of the current rate. You don't wait for a forward rate, which is a speculation. So you can only maximize on the current rate. You don't wait for the future rates or speculate to the speculative rates. So what you do, if you have a payable, which we said is more or less like the matching concept when we were talking of internal methods, if you have a payable denominated in US dollars, create a receivable denominated in US dollars, which are maturing on the same day. So the proceeds from the receivable is what you'll use to pay the payable. If it's a receivable case, you create a payable or a debt, a loan with a bank, which once you are being paid your receivable, you go and pay the bank. We are going to take an example on that. I want to share a different screen, which will give us an example on that. Then we'll be able to do the computations, you understand more. This is about money market hedging. I think I've shared this note. So about forward contract, we have taken an example. So with money market hedging, I want us to take this example. Let's assume you have a receivable. You receive 400,000 in 3 months. You're expecting 400,000 in 3 months. You're expecting 400,000 in 3 months. 400 US dollars in 3 months. Hope you are copying the question because I will not be able to share the two screens at the same time. The spot rate, which is the exchange rate now, is $1. It's 82.50 to 1.8361 pounds. Then you are told the deposit rate. It's 4.5% in UK. Then 4.2 in US. These are annual rates. Take note of the annual rates. Then you have the borrowing rates, which is 5.75% in UK and 5.1% in US. These are also annual rates. Take note of the formula I've given there. It's very useful for our calculations. So now, how much will you receive if you decide to go for the money market hedging? If you opt to go for money market hedging, I want to add something here. You already have the forward rates. You have the borrowing rates and whatever. Of you have taken the forward rates. We also have the forward rates. Make sure you take the full question. Forward rates. It's 1.8338. The other one is 1.8452. Those are the forward rates. Now the question is, should you take money market hedging or should you take forward hedging? So should you opt? Should you take money market hedging or forward contract? That is the question. Should you take money market hedging or should you take forward contract? In this case, these are receivable you are expecting. You have the forward rates with you. You have the borrowing rates. Then you have the fixed deposit rates. You are in US, you are in UK, and this is an amount you are expecting from a customer in US. And it should be paid in 3 months. Those are the rates. So I want us to take that example, which will help us understand money market hedging better and also understand the forward rate more. Hope you took the question because I don't have, so it's you guys will give me the rates. So in our question, the receivable you are expecting is 400,000 US dollars. That is the receivable we are expecting, which should be paid in 3 months. That's a receivable we are expecting, and it should be paid in 3 months. We have what we call spot rate. The rate is at now in the market. The spot rate we are given is 1.825 to 1.8361. Then we are told the forward rates. We also have the forward rates. We have the forward rates, which is 1.8335. Then we have 1.8452. Those are the forward rates. Deposit rates. Deposit rates. We have 4.5%, that is in UK, and 4.2% in US. These are annual rates. There's a reason why I'm insisting the annual rates, because we are looking at a period of 3 months. Borrowing rates. We have in UK 5.75%. Then we have in US 5.1% annual rates. So we have our question, should you opt for forward contract? So the procedure is you get the proceeds you'll get if you decide to go for forward contract. Remember, these are receivable. You look at the proceeds you'll get if you decide to go for forward contract, and the proceeds you get if you decide to go for the money market hedging. Then now you can advise the company which option is better, which is giving more proceeds. Now, with the first one, the forward contract, we already have our forward rates, which are given here. Among the two currencies, which one is stronger than the other one? Among the currencies we are dealing with a pound and a dollar. Which one is strong?
Pound.
Pound.
So what does this exchange rate mean now for the forward rates? We are receiving our, just a minute, I don't know why we have touched now. We are receiving our 400,000 in US dollars. And we have these rates given here. The forward rates are here. So at what rate will you change our currency? In this case, you are in UK. These are the exchange rates you are given. So at what rate will you change your currency? Remember, this means 1 pound. 1 pound equals to this number of dollars. So in this case, what rate will we use to change our currency? This is buying, this is selling. So what rate do we use to change our currency?
1.8335.
1.8335. So it will be one pound equals to 1.8335. What about how many US dollars? What about 400,000? So how much do you expect to get from this? How many pounds will you end up with? How many pounds will you end up with?
218, 161.99.
161.99. So that's the number of pounds you will get if you decide to go for forward contract. So take note of this because it's what we'll compare. If you decide to go for forward contract, that is the amount you'll get at the end of the transaction. Now, the other method we are supposed to compare with is money market hedging. Money market hedging, we are saying in our case, we are expecting a receivable. In our case, we are expecting a receivable of 400,000 US dollars. So we need to create a payable. We need to create a payable. We need to borrow a loan, which at maturity will be equivalent to this amount. So we are borrowing in which country? We are in UK. Are we together? Tuko pamoja hapo? So we are in UK. We want to borrow a loan such that at the maturity it will be equal to 400,000. That is the principal plus the interest. It should be equal to 400,000. That is the first step. So how much do we borrow such that at maturity it will be 400,000? The borrowing rate we are using is for UK. We'll use the borrowing rate for UK because we are in UK. So the rate we are going to borrow at is 5.75, and this is an annual rate. And remember, we are looking at 3 months, not the whole year. That's why I kept insisting on the annual rate. So how much do we borrow? We already know our future value we need is 400,000 equals to, we will now want to get the present value. What we are computing is present value, which is the unknown. So what we want to get is the present value at this rate. So which formula do we use? Which formula do we use? How do we calculate present value? From financial management, how do we calculate the present value? For financial management, how do we calculate the present value? How do we calculate the present value? First of all, let's deal with the rate. What rate are we going to use? Remember 5.75, you have to divide by 12 to get rate per month, then multiply by 3. So what borrowing rate are we going to use? Because we cannot use the rule of 5.75, that is for 12 months. So you divide to get per month and multiply by 3. So what is the borrowing rate?
1.44.
1.44. So that is our borrowing rate. So we know our future value is 400,000. That is the value we want to have in future in the next 3 months. So what we don't have is our present value. Divide by 1 plus R, which is 0.0144, raised to power 1. It's just 1 period. So how much are we supposed to borrow? We are looking for the present value. So if you solve the equation further, what you get is a present value divided by 1.0144. So you multiply by 1.0144, multiply by 1.0144. So how much should you borrow? I want to see whether the formula we are using is correct. How much are you supposed to borrow? How much are we supposed to borrow?
For 17,600.
Then the formula has a problem. Someone to confirm how we are supposed to, how we should calculate the present value. That is what I'm trying to confirm kindly. Should be minus, not plus. The R. Future value equals to present value divided by 1 plus minus R. So the formula here is the one which has a problem. That's why I wanted us to confirm this should be minus, not plus. So how much do we borrow in this case? So we have our future value, which is 400,000. It is 400,000 equals to our present value is our known factor, 1 minus 0.0144. So how much do we borrow? What is our present value?
$394.
384. Sorry?
No, 394.
394.
302.
394.
322.
322.
300. Yeah.
That is the amount you need to borrow. So now this means that the amount you have borrowed in the next 3 months, it will be equivalent to 400,000 at the interest rate of this amount. So now that one you are sorted, you will borrow 394. After 3 months, the bank will be expecting you to pay back 400,000. Are we together? So what will happen? Once you are paid your receivable in dollars, which you are expecting in 3 months for 400,000 USD, you just pay the bank directly. Now you have your money before the payment has come. You have borrowed a loan, so you have created a receivable, a payable. You have borrowed a loan, so you convert this at the spot rate. What is our spot rate? At what rate do we convert? Because you should convert your money now to your home currency. Should convert your money to home currency and put in a fixed deposit. Should convert money to your home currency and put in a fixed deposit. So what rate do we use to convert this currency? What rate do we use to convert the currency? You have borrowed US dollars and you're in UK. So you want to convert to your home currency. From our rates, from our question, these are the rates we are given. So we want to convert it to home currency using the spot rate now, because we have received the money now. You create them on the same day, the receivable and payable. So what rate do we use to convert our currency? What rate do we use? Are we together?
1.84. 250.
1.8361.
And the someone is saying the 1.8361, another one is saying 1.8250. Which is which?
8250.
The exchange rate spot rate is we are given as 1.8250. Then we have 1.8361. This is buying, this is selling. You have a foreign currency in your home, so you are going to the bank to sell. So they will do buying. Are we together? So you use 1.8250. So in our case, how much have we borrowed? We have borrowed 394, 322. So we have borrowed 394, 322. So we convert at what rate? 1.8250. So how many pounds do you end up with? How many pounds do you end up with?
216,066.
216,066.85.
66.85.
Pounds. Now, this money you have received it, and maybe let's assume the trader did not have another form of investment. He decides to put in fixed deposit. You decide to put in fixed deposit, and you're in UK, so you'll do the fixed deposit at the rate of 4.5%. You're in UK, so your rate will be at 4.5%. Remember, 4.5 is an annual rate, so you'll have to convert it to 3 months. Divide by 12 times 3. So what rate will be your interest rate? What will be your interest rate? What will be your interest rate?
1.125.
125.
1.125. So now you have your 216,066.85 pounds. You put in a fixed deposit at the rate of 1.1. You fixed it at the rate of 1.125%. What will be your maturity amount? How much will be your maturity amount? Remember, your maturity will be 0666.85 times 0.01125. This will be the interest plus the principal. So what is our interest? How much interest will your money earn?
24,000.
Sorry?
24,000.
24,307.52.
307.52.
300.52.
Yeah.
So what will be your proceeds from money market? It will be 216,066.85 plus the interest which the money will earn. So what will be your proceeds from the money market hedging? What will be your proceeds from money market hedging? What will be your proceeds from money market hedging? What will be your returns from money market hedging?
240.
240?
374.37.
374.37. So these are proceeds from money market hedging. And the other one we are supposed to compare with, it's 218. So which method is giving you better returns? Which one is giving you better returns? We have 240 and we have 218. In this case, you would advise the company to get the money market hedging.
Yeah.
So in this case, you would advise the company to opt for the money market hedging. I don't know whether there's any question about those two. I don't know whether there's anyone with a question about those two. Forward contracts and money market hedging before we take a break for 2 minutes, then we come back for the another session. So in this case, I think I've given the notes which are clear. So that is the example we are taking for money market hedging. With money market hedging, we say that it involves a contract and a source of fund to fulfill that contract. That is where you are creating a receivable or creating a payable. It's reversing foreign currency receivables stroke payables by creating a matching payable stroke receivable through borrowing in the money markets. So what you do, you borrow or you put a fixed deposit. So that is what we call a money market hedging. There's another example. I think if you ever do the financial risk management, you will discuss money market as a speculative tool. But now for this class, we are using it purposely for hedging. I don't know whether there's anyone with questions so far. Any question? Someone is asking whether hizo examples ziko kwa notes, but they are not worked out. So you need to get the workings. They are not worked out. They are there, but they are not worked out. You need to get the workings. That is the advantage of coming to class. That's why you need to be in the class for us to work out the workings, because hata nikikupea the solution, some will have challenge of understanding how we go to it. So they are there, but they don't have the workings. So I need to give you a break, though I'm not getting out of the meeting. You can just hold the discussion among yourselves for like 5 minutes. Then we'll be back for like 15 minutes. We discuss future contracts. Then we'll continue in the next class. But for now, it's a break of 5 minutes. You can have discussion among yourselves. Try to ask where you didn't understand. Then we'll be back in 5 minutes. That is by 7. We'll do like 15 minutes to discuss future contracts. Then we'll call it a class.
Hii 218 tulikuwa tunaipata wapi? Excuse me, somebody to help me. Hii 218 tulikuwa tunapataje?
Yani hiyo forward contract.
Yeah.
So
I'm not even
see,
having my workings.
it's by dividing the receivable 400,000 USDs with the spot rate, which is the buying of 1.8335.
1.8335.
Can you come again, please?
To get, we divided the receivable 400,000 with buying spot rate of 1.8335. That's the forward rate because it's the one we're expecting in future.
Sawa, yuko sawa hiyo.
Oh, the forward contract.
Yeah.
And then we got to 218. Okay. So thanks.
Ian. Ian.
Yes, mkubwa.
Niaje. How are you?
Sana. I'm very fine.
And
How are you?
I'm fine.
Nice. Niambie.
We, Jemu, hii money market hedging umepata? Ian,
Demon kama mic yake.
hii money market umepata? Ian umemute, ni nini bwana?
Class rep anaweza ongea na teacher akuwa na share hizi recording kwa Moodle so that during revision tuko na working na maswali. Class rep.
I think I've seen your concerns. Are we back?
Yes, Mwalimu.
I've seen your concerns. I'll try, though I'm not really an expert in video uploading. I have the videos with me. The problem is how to upload. Let me consult our support team. I see how to upload it on Moodle, because I've never done one before, but I've seen your concerns, which are genuine. But someone is saying anasoma kwa matatu. Immaculate, kwa nini unasoma kwa matatu?
Yeah, huwa tunasoma kwa matatu because ukiwa kwa jam na class ikianza, what do we do?
Inabidi uingie.
Yeah.
Okay.
Mombasa road ni mbaya sana.
That's okay. I'll consult my people. If the worst comes to the worst, then I'll do through WhatsApp. But I know WhatsApp would be a bit heavy because it's a recording. But I'll consult the guys who are a bit who knows the Moodle better than me. Tomorrow, who is our class rep? Class rep tuliagree ni nani? Who volunteer to be our class rep? Anyway, Caroline Ochieng, kindly remind me tomorrow that I see how to upload the videos.
Okay.
Because I know I'll forget. So someone needs to remind me in the morning so that I can see how to upload the videos.
Okay.
If they can be edited, we cut the parts which are not necessary, then I think they will be small. So they need someone who knows how to edit, and they will be manageable. So I think we need to do the last part. I can see some people almost getting home. So watakuwa wanashuka kwa matatu.
Mwalimu, a quick one.
Yes.
A quick one before you proceed.
Yes.
Are your answers rhyming with the ones you're getting after computing? Well, as we continue with the class.
Which answers?
You know, like for the forward contract and for the money market hedging. Your answers are the same as the ones we are getting as we are computing.
As in, are they correct? Whatever we are getting, that's what we're asking.
Yeah, exactly. That's the
yeah,
question.
they're okay. They're okay. If we go off like the one we had gone off, I'll know because something I've used in another class, so I know what we should be getting.
All right.
So I think the last part I want us to mention is about forward future contracts. The last bit I want us to discuss is what we call future contracts. When we talk of future contract, the definition is more or less like the forward contract. It's actually a rate agreed now to be exercised in the future. So when you talk of future markets or future currency futures or future contracts, so because books will use different terms, there are some which will call it future market hedging, others will call it currency futures, others will call it future contracts. They are all the same. Now the definition for this one is more or less like the one for forward contracts, but they have some differences. With future contracts, they trade in the stock market. They trade in the stock market. They are just like shares. They trade in stock market. They are like shares. So what you do, if you have a receivable which is exposed, you get a future, you buy a future which is maturing the same date with your receivable. Let me share the other screen where I can write. I don't know how to explain without writing. So what do we mean by future contracts? Future contracts. Some books will call it currency futures. When you are doing financial risk management, you'll use currency futures because it is more of derivatives. So the definition is the same as forward contracts, but these ones trade in the stock market. They trade in stock market. They are like shares. So what do? If you have a receivable, which is maturing, let's talk of 31st of May. I don't know whether there's 31st in May, 2021. You buy a future which is maturing on that date, or even a date beyond that one. maybe the futures in the market, because they are trading in the market. You might realize the futures which are there, they were the standard ones. They have 3 months. The first one matures on March 2021. There's that first one. Then the next one will be 30th of June 2021. Then you have September 2021. Then we have December 2021. These are the standard maturity dates of the futures which are trading in our stock market. So now if you have a receivable which is maturing in May, you don't have a future maturing in May, and there's nothing, the one you have is in March and the other one is in June. What you do, you get the future for May.
Chemsha maji ya ugali.
Hey, Judy, mute yourself, Judy, kindly. So if you have a receivable maturing in May, what you do, you get a future contract maturing in June. But because they trade in stock market, come 31st of May, you can dispose your future or the rates which will be prevailing in May, because they are marked in market daily. They have a price they're selling at daily in the market. They are just like shares. The other difference between this one and the forward contract is that they have standard sizes. They have standard sizes. They are standardized, unlike the forward contracts, which we said is customized. So the standard one in Kenya is 62,500. The standard one in Kenya is 62,500 Kenya shillings. So if you are buying a future, I don't know whether it's denominated in Kenya shillings. So if you are buying a future, you cannot buy a half future. If you are buying a future, this is denominated in dollars. So if you are buying a future, you cannot buy a half future. What do we mean? Let's assume you are hedging yourself against 450,000. And we are saying the standard size of future is 62,500. So how many futures should you buy? When you divide, what are you getting? What are you getting when you divide these two? Hope it's not a round figure.
7.2.
11?
7.
7.2. So what does it mean? For you to be fully hedged, you'll have to get 8 futures. You cannot get 7 because you'll be less by 0.2, and you cannot get a 0.2 of a future. So you have to buy 8 futures. So that is what we mean when they have standard sizes. So if you are hedging 450,000 US dollars, you have to get 8 futures for you to be fully hedged. You cannot get 7 because you will not be fully hedged, and you cannot get a 0.2 of a future. That is what we mean by standard sizes. The other difference between forward contracts and the future contracts is that future contracts has less counterparty or whatever risks. It's a legal contract which is binding. It has no counterparty risk. It's a legal contract which has no exposure to the counterparty risk. You cannot say that one of the parties will default. So it is protected, unlike the forward contract where we have said it has issues of counterparty risks that a party might decide not to honor their part. So I would like to summarize those differences. I would wish to summarize to do summary of those differences. So we have the forward contract. The definition with the future contract we have said is the same. With the future contract we have said is the same, but they have very significant differences, which is what is of importance for you to note. Then we'll take an example for future contracts. So with forward contracts, there's what we call counterparty risk. There's counterparty risk. With future, no counterparty risk. There's nothing like counterparty risk because it's a binding contract. This one is a over-the-counter agreement. Over-the-counter agreement. But this one, it trades in stock market. trades in stock market. This one is customized. It is customized, but this one has standard sizes. It has standard sizes. This is what we call this one marks in the market. That is that it has a price in the market every day, marked in market daily. Unlike this one, which does not trade in stock market. Then the last one, this one you have to wait until maturity date for you to exercise it. You have to wait until maturity. This one you can close before maturity. The example I was giving, you can buy a future of June but dispose it in May. So you can close before maturity. You can close this one before maturity forward. That is future contract. So those are the differences between the two. I know most of the books will divide them to mean almost the same, but there are those significant differences. Future contracts behave like shares. They're just like stock or the stocks which trade in the market. So they are marked in the every day. Even if you have a future which you are holding, and the customer happens to pay early, then it means that you can dispose your future on that day. You can get a price on that day in the market. That's why we are saying they are marked in the market on daily basis. So I want us to take an example. I think it is in the notes. I want us to take an example, which is in the notes, on future contracts. Those are the examples, the exchange traded, the future contracts. Those are the differences. Future contracts are regulated, unlike forward contracts, which are not regulated. Future contracts are standardized, unlike forward contracts, which are not standardized. There's counterparty risk in forward contracts, unlike in future contracts. Then there's upfront costs. There's a cost you have to incur. In forward contracts, there's nothing we are paying, but for the futures, you have to buy the future. So you have an upfront cost. There's a cost you are incurring immediately. I don't know whether to take this example. It's a bit complicated, but it's worked out in the notes. So remember, notes I've shared in two. Galax A10, kindly mute yourself. Let me just mute all of you. So I was saying this example is well worked out in the notes. I don't know whether we need to take it, but we can just check through it briefly. Then we'll be concluding our class. So the challenge I have is I have to copy the question at the same time, because I don't have my printout with me. So the question is, in December, UK exporter invoices 400. A UK exporter invoices US dollars 407, 500. That is the invoice. So that's a these are receivable, payable in February. It's payable in February. The exporter needs to hedge against an exchange rate whereby sterling becomes stronger in case there is a variance in the exchange rate. To hedge this exchange rate exposure, the company could take out either a forward contract or a future contract, which would be more. Then the question is, which one would be more appropriate? So in December, when the transaction is happening, the spot rate, we have the spot rate, which is 1.9575. Then we have 1.9595. So that is the spot rate in December when the transaction is happening. Then the February forward rates, we have 1.9550. Then we have 1.9575. Those are the forward rates. Then on that day, the March starting, the March starting future is selling at 1.9655. Then if you were to buy, this is the rate at which you would buy the future contract. which is 1.9600. The standard size is 62,500 pounds, as per the question. So in February, when the transaction is maturing, the spot rate in February is 1.9670 to 1.9690. Then the future contract rates is 1.9655. Standard size remains 62,500. So you need to advise this company whether it should take a forward rate, whether they should consider forward rates, or they should opt for future contracts. So that is what we need to advise the company. So that is what I want us to give an attempt. Hope you are copying the question. I'm giving you time to get the question. For those who are in the matatu, you will follow after we have shared the whatever we'll have computed. So you have the rates given there, the rates in December, the rates applying in February. So now the first thing we need to discuss is the forward rate. Let me share the screen where I can write. This is in the notes, so just follow on the computations because I can see time is really, I don't like taking 2 hours in a class, but let me try to see whether I'll manage. So in this case, we are supposed to advise this company. It's a company in UK. It has an invoice, it has a receivable of 407,500 US dollars. This is what they expect to be paid in February. This is expected to be paid in February. So we have the spot rate with us, spot rate in December. The spot rate in December, it's 1.9575. Then we have 1.9595. Then we have February forward rates, which is 1.9550. Then the other one is 1.9575. So that is the forward contract rates. So in this case, before we continue beyond there, if you decide to go for forward contract hedging, how much proceeds will you get from this receivable? If you are the company and decide to take forward contracts, how much returns will you get from this contract? How much returns will you get from this contract? This is a buying price, this is a selling price. So we are saying you have been paid the 407,500 US dollars. What rate will you change your currency at in the forward rates? At what rate will you change your currency? At what rate will you change your currency? 1 point? 1 point?
9550.
9550. So how many pounds will you end up with if you opt to go for the forward contract? It will be 407,500 divided by 1 point?
9550.
So how much will you end up with?
208.
2?
208 for 39.9.
208 for 39.9. It's just now I'm realizing the example we have in the notes. It has an issue. It's using the wrong rate. So the notes have an issue. So now I'm realizing because I'm seeing in the notes, the detailed notes, which I said I shared, which I know what. They have an issue. The rate we have used here, it's wrong. So we are supposed to use this rate. Remember, you're in this country, you have this currency, so you are selling, the bank is buying from you. So this is the rate you should use. So that is the amount you would get if you opt to go for forward contracts. Now, how do we go about future contracts? Future contracts. First of all, how many contracts do you need to get? How many futures do you need to get? That is where we should start. How many futures do you need to get? You need to get to protect yourself from 407, 500. This is the amount you need to hedge yourself against. The rates we are given, the March future, which has a standard size of 62,500, the rate is £1 equals to 1.9600 US dollars. So the first step is to convert these to US dollars, to pounds, then divide by the standard size. So how many pounds do you end up with? Because we want to hedge against this. So you have to convert it to pounds. Remember our future is 62,500. One future is 62,500 pounds. So you convert this one to pounds. How many pounds do you end up with? How many pounds do you end up with? How many pounds do you end up with?
270.
200?
2,007.
207?
207, 908.
908. So you need to hedge 207, 908 pounds. Divide by 62,500. We need to know the number of futures you need to buy. So how many futures do you need to buy? How many futures do you need to buy?
I think it is 4.
Sorry?
4.
You are getting 3
It's 4
points?
because it is 3.326. 326.
326. So if you need to get 4 futures, you are going to invest for 4 futures. The rate at which you will buy remember 4 futures will be equal, it will not exactly be equal to this number of pounds. So how many pounds will you need to spend to buy those futures? It will not exactly be 207 because we are rounding it off because we said futures are standardized and you cannot get a half future. So how much will you put in that contract? How much will you spend to buy the future? How many pounds?
250,000.
Sorry?
250,000.
250,000. So you are going to commit 250,000 to buy 4 futures. Remember the futures we have bought are maturing in March. They are March futures. But our transaction is maturing in February. Our transaction is maturing in February. So the rate at which you will buy the future will be 250,000. So how many dollars? You convert these to dollars at the rate prevailing for the futures on that date. So how many dollars will you be expecting? You are going to buy a future denominated in pounds, but you are using dollars. So how many dollars will you use to buy the future? Because the future is selling at 1.9600. That is the exchange rate for the future. So how many dollars? 490,000. 490,000.
490.
So this is the amount. 90,000. So that is the amount you are going to commit to buy the futures. So on the maturity date, which is happening in February now, you are holding your futures worth 490. So on the maturity date, which is happening in February, remember we said with future, you don't have to wait for the maturity date. You can close before the maturity. In February, these futures are selling at what rate? Our futures are selling at what rate? On maturity date, our futures are selling at what rate? In February, because you are holding 2 futures worth 62,500. This is the amount you spent to buy the futures. Now you want to sell the future because your transaction has matured. So the futures are trading at 1.9655 in February, the March future. Remember we said they are marked, they have a price every day in the market, so you can sell in any day. So how much proceeds will you get from this? You have 4 futures, each worth 62,500, and they are selling at this, they are converting at this rate. Let me not use the selling. When I talk of selling, it will sound more of derivatives. They are converting at this rate. So how much proceeds will you get?
It's 491.
491. 491?
370.
375. Okay. So now this is what you use to buy your futures, and this is what you have taken. The profit, this is the profit you get, and this is what you use to invested. So the profit you will get will be how much from holding the future? Because in this case, you only hedge yourself with the profit you will get. So how much will you make as a profit? This is the amount you invested in the futures. Come in March when your transaction is maturing, you sell your future to this. So how much profit will you make?
41,375.
How much profit?
I think it will be
1,375.
1,375.
1,375. This is in dollars. Are we together?
Yeah.
So that's the profit you'll make of dollars from holding the future. So you convert these to pounds. You convert these to pounds because remember we are in UK. So on this date, this is a profit you will make in February when your transaction is maturing. Then your company will also pay you your 407,500. The 407,500, which now you convert at the spot rate in February. Our spot rate in February is, we'll use 1.9670. That is the rate we'll use to convert our profits and our proceeds from the sale. We'll have done a proceed. So how much will you get from you have been paid this amount on the day, February, when you are paid the amount, you convert on the spot rate plus the profit you'll have made from the future. That profit is what protects you from the exposure. So how much will you get from the sale? 407,500 divided by 1.9670. How much will you make?
You get 207,168.
207,168. So this is what you'll get. Sorry? Someone is talking of 43 somewhere. Sijui imetokea wapi hiyo.
I was saying 207,168.3.
Okay. So that is what you'll get because you'll be paid your money on that day and change it on spot rate at the rate which is prevailing on that date. So this profit you also made from holding the future, because I said with future contracts, you are only protected by the profit you will make or the loss you will make. So this profit you also made, you need to convert to pounds at the rate on that date because you'll get it on that date. How much will you make from the profits? How much profit will you make?
699.
699. So the proceeds you will get from the future contracts, I'll recommend that you do more revision on this. But the notes which are in Word, I will do some editing. I'm only realizing that I used the wrong rates. I'm realizing when we are doing the example. So mwenye alikuwa na doubt the example we are doing, I'm very keen on it because it has helped me realize the notes I have, they are wrong. And I've shared to several classes. Then I'll do the corrections and share again. So how much will you end up with from this transaction? So the amount you'll end up with is 207,867. That is the proceeds from the receivable by converting it on the spot rate on the day of maturity, plus the profit you are making by holding the future. Now, if we compare it with what we were getting, what were we getting from the money market hedging? Money market hedging was giving us 208. So you compare the two, 208 and 207. You opt for forward contracts. Sorry, not money market hedging, forward contracts. So that's how you go about future contracts. The future should not bother you so much because for purposes of hedging, it's not really a common method. We'll also talk more of it when we are handling options, currency options. So just do revision of what we have done. Then we'll pick it from there next class. I have said I promise to share the videos. Hope they are recording. Unfortunately, the second session, I don't know whether I've recorded.
Yeah, you have.
Yeah, it's recording. So I will share the the recordings, follow that. Then I'll not give a quiz this week, but next week after we have done currency options and currency swaps. Next class will be a bit short because we'll only discuss currency swaps and currency options. Then we'll be able to get a quiz from this specific topic, which will give us our main cut. Our main cut will cover from this topic, which will be not a multiple choice questions. So you prepare for that, but I'll still upload it in Moodle with like 3 or 4 days to tackle. So our main cut will come from this topic after next class. Any question? I think then we can meet on Wednesday the same time. I'll try to be where I am because today we have not had issues with the network.
Sure.
Suzu, we have never met. Let me put the video on because I know some of you are still not sure who is teaching. So I'm in student finance. I'll repeat that for purposes of those who have never seen my face. You know, I've realized I have students in the class who came in 2020 during COVID, so they have never come to school.
Yeah.
Okay, then let's meet in the next class.
Mwalimu
Thank
just
you,
anasema-
Mwalimu.
Thank you. Good
Mwalimu,
night.
Good night.
Thank you. Good.
Mwalimu, please don't set hard questions.
Okay, I take it here.
Yeah. Pleasure to meet you.